Welcome to this video, which describes the average internal rate of return. Average internal rate of return. We will also call it AIRR. The AIRR is a comprehensive approach to valuation. It is based on a very simple idea. The idea is that a rate of return is a ratio by definition, and it is the ratio of the total return generated by a project to the total capital invested in a project. Total capital invested in a project. Consider a firm which faces the opportunity of investing in a one-period project. This means that there are two dates, 0 and 1. And suppose that the capital invested in the project is $600. And suppose that the profit generated by the project, or the income, profit or income, is $375. What is the rate of return of this one-period project? Simply, the rate of return is an amount of return per unit of invested capital. So we simply have to divide the profit by the capital. Let us denote the rate of return as I, and we divide 375 by 600. That makes 62.5%. Now, is this 62.5% a good rate of return? Is the project worth undertaking? It depends on the cost of capital. Suppose that investors might invest the same amount of capital in the security market and that the market rate is 15%. In this case, 62.5% is greater than 15%. That means that the project is worth undertaking. The project is worth undertaking. We can also say that the project creates value. The project creates value. How much value creates this project? Now, consider that the excess return rate is 62.5% minus 15%, and this makes 47.5%. So this project consists in investing $600 at an excess return rate of 47.5%. This net gain is generated in one period. So if we want to compute the net period the net gain in referred to time 0, we have to discount back by one period using 15% as the discount rate. This makes $247.83. Now this is the net present value. This is called the net present value. The acronym NPV is often used. Net present value. Let us generalize the discussion to a project with 2 periods. Consider a 2-period project, which means that we have to do with 3 dates: 0, 1 and 2. Suppose that the capital invested in the first period is still $600. And suppose that at the beginning of the second period the capital that remains invested in the project is 400, which means that the asset depreciates by $200. And suppose also that the income generated by the project is 375 in the first period and 235 in the second period. Now we have two capitals invested and 2 profits, 2 incomes. So what is the rate of return of this project? In this case, in this 2-period project, we just have to divide the total return generated by the project, total return, by the total capital invested in the project, total capital. Let us keep the assumption that the cost of capital is 15% and consider that there is a lag of 1 period between the first income and the second income, and there is a lag of 1 period between the first capital invested and the second capital invested. So as for the total return, we have to add 375 and 225, which we discount by 1 period at 15%. Remember that there is a lag of 1 period between the first income and second income, so we sum the discounted values. As for the total capital, we add 600 and 400 discounted by one period, because there is a lag of 1 period between the first capital invested and the second capital invested. So we have a total return which is equal to 570.7, and the capital that generates it is 947.8. So the rate of return of this project is the ratio of the total return 570.7 to the total capital invested 947.8. The result is 60.2%, and 60.2% is greater than the cost of capital. This is greater than 50%. So comparing the project's rate of return and the cost of capital, we can say that the project creates value. So let us write that the project creates value, and therefore the project is worth undertaking. How much value is created? Now we can compute the value created. by considering that the excess rate of return is 60.2% minus 15%. This makes 45.2%. Sorry, 45.2%. We can interpret this project as a project where an overall capital of $947.8 is invested at the excess rate of return of 45.2%. So the product of the total capital invested and the excess rate of return gives us the net gain. We want to refer it to time zero, so we have to discount it back by one period. We discount it by 15%, the cost of capital, and we get the net gain referred to time zero, which is the net present value, 372.6. This is the net present value, NPV. I'll consider a project lasting 2 periods and let the incomes be denoted as I of 1 and I of 2, while the capitals invested are denoted as C of 0 and C of 1. R is the cost of capital. The rate of return is given by the ratio of the total return to the total capital, I1 plus the discounted value of I of 2 at the rate R, and the total capital is C of 0 plus C of 1 divided by 1 plus R. And so we have a numerator which is the total return, and a denominator which represents the total capital invested. More generally, if consider a project of n periods, where n is equal or greater than 1. So, I suppose we have n plus 1 dates, 0, 1, 2, 3, and so on, until n. We have n incomes, which we denote as I of 1, I of 2, I of 3, and so on. The last income is I of n. And then we have the capitals, n capitals, which are invested at the beginning of each period. C of 0 is the first capital, then C of 1 remains invested at the beginning of the second period, and C of 2 remains invested at the beginning of the third period, and so on. Now let's add the time n minus 1, so we have the last capital that is invested at the beginning of the last period at time n. The capital invested is 0 because the project is over. Now the rate of return of this multi-period project is obtained as the ratio of the total return to the total capital. The project rate of return is the ratio of the total return to the total capital. Total return is I1 plus I of 2 discounted by 1 period plus I of 3 discounted by 2 periods, and so on until the last income is discounted by n minus 1 periods. And the same for the capital. First capital is C of 0, the second capital is discounted by 1 period, the third capital is discounted by 2 periods, and so on, and the last capital, which occurs at the beginning of the last period, so at time n minus 1, is discounted by n minus 1 period. So we have total return divided by total capital, and this is an average rate of return. We can call it average internal rate of return with the acronym AIRR, where A means average. Now that this is an average rate of return, it should be clear from the ratio, the ratio of total return to total capital. We have shown that a rate of return is equal to the ratio of total return to total capital. So assuming the cost of capital is R, the rate of return can be computed in an easy way from the profits and the invested capitals. Now, in a one-period project we have only one income, and we divide it by the only capital invested at the beginning of the first period at time 0. If we have a two-period project, then we just have to add the second income discounted by 1 period and as for the capital, we just have to add the second capital invested in the second period discounted by 1 period. And if the project is a 3-period project, we just have to add the third income discounted by 2 periods, and at the denominator we have to add the third capital C of 2 discounted by 2 periods, and so on until the last period. In the last period we have the last income discounted by n minus 1 period, and we have the last capital which remains invested in the project at the beginning of the last period, which must be discounted at the cost of capital by n minus 1 period.